Welcome to the Recon Trader. In today's video, I will share with you a new delta neutral yield farming strategy by Aperture Finance, which you can deploy with one click and earn up to 45% APR. Now, if you're not familiar with Aperture Finance, we can jump over here to their docs, and in summary, Aperture is a cross-chain DeFi investment ecosystem with an app store consisting of basic strategies, which will include vanilla yield farming, lending, borrowing, advanced strategies, which covers that delta neutral strategy, and then they're going to have some utility tools like standalone cross-chain swaps, borrowing rate checker. It looks like at the end of the day, they want to take care of all your DeFi needs in one place with one click. And that is what I like about their delta neutral yield farming strategy, is I can deploy it simply by one click. Now, I'm not going to do a deep dive into their documents. Of course, I expect you to do your own recon. There is some good intel here. They've had a security audit that was completed by Oak Security. Now, I don't actually know who that is, but you will definitely want to do your recon on that audit. And you most definitely need to go through each one of these tabs as part of doing your own recon. And today we will be doing a little deeper dive, obviously, into the delta neutral strategy. And by the end of the video, I will show you actually how to set up and deploy one of these strategies. So, if you're not familiar with what a delta neutral strategy is, it is basically a portfolio strategy utilizing multiple positions with balanced positive and negative deltas, so that the overall delta of the asset in question totals 0. Essentially, you create a delta neutral position by going long and short on the same asset at the same time. And in this particular case, Aperture Finance achieves a delta neutral strategy using synthetic tokens. A synthetic token is simply a tokenized derivative that mimics the value of an asset, like a stock or a cryptocurrency. For example, TWTR is a synthetic token of the Mirror protocol that is pegged to the trading price of the Twitter stock, ticker symbol TWTR. Such tokens can be traded 24/7, but these new stock tokens can only be minted during market hours. So basically, you're only really going to be able to deploy one of these strategies during market hours if you're going to deploy it on one of these synthetic stock tokens. But in addition to synthetic stock tokens, there are also synthetic crypto tokens like MBTC, METH, MDOT. Unlike stock tokens, these can be traded and minted 24/7 as the crypto market is open 24/7. So in summary, you're basically opening a short and a long position on a synthetic token like Twitter. Now, as easy as that sounds, it is somewhat complex to actually do manually. This is the flow chart to set up a delta neutral position, and in this case we will be using UST as our initial investment amount. You then need to take 2/3 of your initial investment and deposit it into Anchor protocol. At that point in time, you would then receive AUST, and then you use that AUST via the Mirror protocol website to short a synthetic token. Now on the flip side, you would take 1/3 of your initial investment and via the Mirror protocol go long and thus buy the synthetic token. You would then have to wait actually 2 weeks, and eventually you end up with a delta neutral position. Now Aperture basically does all of this flow chart for you with one click. And so for my delta neutral strategy example, I will be using MTWTR for this example. And the initial investment amount of $900 in UST, which is basically Terra USD, and that's a stable coin that is running on the Terra blockchain network. My initial investment amount of $900 would be divided into two parts, one for the long farm and one for the short farm. 2/3 of the amount, $600, will be deposited into Anchor and be converted to AUST and now earns 20%. with the AUST as collateral and assuming a 200% collateral ratio. Now, I will get into that collateral ratio when we go to deploy this strategy, but for right now, just assume we're using 200% collateral ratio. $300 worth of Twitter or TWTR will be minted and sold to create a short position. The proceeds from shorting the token, $300, will be locked for 2 weeks before being distributed and staked SLP tokens, which are short liquidity provider tokens. Now, the remaining 1/3 or $300 of my original $900 investment, $600 went to the short side. Now $300 is left over and will be used to purchase the TWTR tokens. The tokens will be deposited into a TerraSwap liquidity pool along with $300 proceeds from the short sale side after they have unlocked during that 2-week period. The Twitter or TWTR UST pair will be staked either on Mirror Protocol or Spectrum to earn the long farm yield. Once the delta neutral position is fully established, you will earn yield from 3 protocols. Anchor Earn Interest is the first protocol, short farm yield from Mirror, and then the long farm yield from either Mirror or Spectrum. And so that is broken down for you over here on the right side of the page. You can see my collateral APR from Anchor is going to be around 14.23%. My short farm yield reward would be that 3.82%, which I will earn during the first 14 days. So I'm earning 18%. Now that's a little less than you would earn had you just staked on Anchor Protocol. They pay close to 20%. But again, this is for more of a long-term strategy. Now, after that 14 days, the long farm rewards will kick in. And so you'll capture an additional 3% APR and 11% APR from both Spectrum and Mirror. And you'll capture an additional almost 13% from TerraSwap trade. So after the 14 days, my APR in this example would be around 45%. And again, for you grunts out there, Aperture Finance does all of this for you via one click. You don't actually have to go through all these steps that you would normally have to do if you did this manually. So now you're wondering, is this absolutely risk-free? No, a delta neutral position is not necessarily a risk-free position. There are some risks involved. The first risk would be a liquidation risk. As explained above, there is a short position, a liability you need to pay back eventually in the portfolio, and that portion is subject to liquidation risk. So if you're doing this manually as an investor, you will need to monitor the price movement and adjust positions accordingly. I will tell you, Aperture takes care of this for you, so you won't actually have to worry about that. We'll get into that in a moment. The next risk would be deviation from delta neutral. A change in the price of MTWTR, that synthetic stock that we're holding, will have an impact on the MTWTR UST pair staked. If the price of MTWTR goes up, part of the MTWTR will be swapped to UST, and the dynamic balance of the MTWTR UST pair will tip towards the UST side, with the UST holding outweighing the MTWTR holding. So from the liquidity provider's perspective, this is considered an impermanent loss. However, if you look at the whole portfolio with less MTWTR than before, you end up with a net short position. Part of your short position is not hedged by a long position, so you are no longer delta neutral, and thus rebalancing is needed to return to delta neutral. Again, that is something you would need to do manually if you were going to deploy this strategy manually, but Aperture's got you covered. Now, another risk that you run is price fluctuation of reward tokens. Besides the AUST collateral, which earns you a stable rate of approximately 20%, staking through the Anchor protocol platform, the yield is distributed in the form of protocol tokens. So the rest of your yield is essentially distributed to you in the mirror token or MIR and the SPEC token, which are subject to price fluctuations. They're not stable coins. If the price is on the rise, the token you receive as a reward will be worth more, and vice versa. If that price is declining, those tokens are worth less, and that is where the risk would be involved. If those token prices are worth less, you're obviously not earning as high a yield. From an investment strategy perspective, regularly selling these tokens and reinvesting them will be a way to eliminate that uncertainty. And once again, something you would have to do manually, but Aperture's got you covered there as well. And then the final risk involved is going to be insufficient exit liquidity. Obviously, if there's not liquidity to exit your positions, you're stuck holding the bag. So while this is a valid concern for trading synthetic stock tokens in general, it does not apply to the delta neutral strategy, because when you choose to exit, you are canceling out your positions rather than seeking a buyer to take over your long position. So that risk is definitely mitigated. All right, I know that's a lot to digest. We are just about ready to deploy this strategy, but just hang in there one moment as we go over the Aperture advantage versus doing this manually. While the above can be done manually, there is a considerable amount of labor, not to mention the possibility of manual mistakes and poor timing, basically not being able to open the long and short position at the same asset price. Aperture has developed smart contracts to automate the transactions with additional features. That liquidation protection I talked to you about, basically a delta neutral position is not a risk-free position. The short position is still susceptible to liquidation if the underlying asset price rises significantly in a short period. This may result in insufficient collateral and trigger liquidation. Aperture has a liquidation protection mechanism built into the smart contracts, constantly monitoring the oracle price and dynamically increasing or decreasing long positions to allocate the money to meet the collateral requirements. Users will be offered the option to pick their desired collateral ratio. Again, that collateral ratio is something we will pick when we deploy this strategy. The next advantage is auto compound and rebalance, converting the reward tokens to UST and reinvesting in a way to remove uncertainties caused by the fluctuation of reward token prices. Remember, you're getting paid your rewards in mirror and spec, and if those prices go down, then you're not earning as much. Aperture has basically automated that process and will convert those automatically into UST and then reinvest, thus compounding those rewards. The regular rebalance feature returns your position back to a delta neutral state, while auto compound increases your core position so that you are on track for greater yield. Aperture picks the optimal frequency for auto compound and rebalancing for you based on the amount of capital that you invest. What's more, Aperture dynamically compares the quotes from TerraSwap and Astroport and picks the better price available to swap the reward tokens to UST. Now, the final advantage is capital efficiency. While synthetic tokens are set to follow the price of the asset, they are usually trading at a premium or a discount depending on supply and demand. The token price, TerraSwap price, is very sensitive to trading volume. Aperture uses a series of complex algorithms to find the optimum allocation between long and short positions, with the premiums, discounts, and price impacts factored into the calculation to ensure maximum capital efficiency. Now, the last thing I want to cover before we get into deploying this strategy is going to be Aperture fees. There are fees. They're not doing all this work for you out of the goodness of their heart. You are going to get hit with a fee. However, in my opinion, that fee is well worth the ask, because the amount of time to manually do this and monitor this would take away from my normal day trading, where I can earn a heck of a lot more than the fee they're actually asking for this one particular strategy. So at the end of the day, you'll need to decide if the fee is worth the ask. For me, it is, and that fee is basically a 10% fee. The fee is calculated based on net gain only. So only on your profit and not on the principal amount that you invested. Now, with that in mind, when the position value is calculated, Mirror's protocol fee of 1.5%, which you will actually get charged when you close out your position, on the short M asset position is not taken into account since the fee is only charged at the position close. So essentially, you're paying Aperture around 10%, and when you close everything out on the short side of this strategy, you'll also be hit with, it sounds like, a 1.5% fee. And that 1.5% fee is going to apply whether you use Aperture or you try to do this manually by yourself. Mirror is going to hit you with that 1.5%. Again, automating this strategy for me is well worth the 10% ask. So that's enough jaw jacking. Let's get this strategy deployed. And I jump back over here to the Aperture.finance website. I can click on the button that says Launch App up here in the right hand corner. And that will bring you over here to the app for the Delta Neutral strategy. Now, the first thing I need to do is actually connect my wallet to the platform. And in this case, you will need a TerraStation wallet, which is very similar to the MetaMask wallet. It's just a web extension. So I need to connect this wallet to the Aperture Finance app. And I can accomplish that by clicking the Connect Wallet button over here on the left-hand side of the screen. Now, you do have a choice in wallets, but I prefer to use the TerraStation wallet. So I just give that a click. Now I need to grant permission to Aperture Finance. So I click Connect. And now you can see my wallet is connected, but I only have about 44 UST available for use in this particular wallet. So I need to go and buy some UST and then transfer that and deposit it into my TerraStation wallet. So I am going to jump over to KuCoin in order to buy UST. And so if you don't have a KuCoin account, I will drop a link in the description down below. If you use my link, you will get like a 10% discount on trading fees. And at the end of the day, who doesn't want to save money on trading fees? So I'm going to jump over here to the Trade tab at the top of the screen, go to Spot Trading. Now I need to find the UST-USDT pair since I will be buying my UST with USDT. So I can just type in USDT and that will pull up a list of options, and there's USDT, UST. Give that a click. Now I'm ready to actually buy, or in this case sell UST to buy UST. So I need to fill out the sell side of the order, and normally I pretty much 99% of the time execute limit orders, but I want this order filled immediately so I can move on with this video. And so in this case, I'm going to come over here and click market. And so now my order will be filled at the best market price, and I'm going to spend 1,000 USDT and click sell. And since it was a market order, more than likely it was filled instantly. So I can come over here to my assets tab and give that a click. And in my trading account, I now have just about 1,000 UST. Now I can transfer that to my main account to withdraw, or I can just come up here to withdraw, give that a click. I can then search for the coin I want to withdraw. It actually happens to show right here, UST, so I give that a click. Next, I need the wallet address, so I need to grab that from my TerraStation wallet. So I need to open that up and copy the wallet address. And that is going to be this address you see here. So I can just click the little copy and jump back over here to KuCoin and paste that address in here. The network is going to be the Luna Terra network. And of course, you always want to make sure you're sending it via the correct network. If you send it via the wrong network, your tokens will be lost. Now, TerraStation, as the name indicates, is on that Terra Luna network, so I know I'm okay there. I do not need a memo. And then the amount I want to transfer is the max amount. Now, if you look down here, it says I have 0, so I need to actually transfer all of this from my trading account to my main account. And so I can just click on the available amount down here, hit confirm, and now you can see the max amount I have available is 997. Yes, I had 999.9, but some of that UST does need to be allocated to pay the fee, and the fee in this case is going to be 2 UST. And so now I'm ready to send this, so I click confirm. You definitely want to verify the amount and the address you're sending to. Now I can click confirm withdraw. I need to put in my security codes. Once I have all my security codes in place, I hit submit, and the transaction is successful and will show up very shortly in my Terra Station wallet. As you can see, within less than a minute, the UST has now arrived in my Terra Station wallet. And so now if I jump back over here to Aperture Finance, more than likely I'm going to need to hit the refresh so that the balance will refresh in my wallet. So I just give that a click. And now instead of the 44 UST, you can see I now have 1,042 UST. And now with that all out of the way, I am ready to go ahead and deploy this strategy. And so now I need to select the synthetic stock I actually want to trade. And you can see there's a list of them anywhere from Apple to Airbnb, AMD, Amazon. You can also find the total value locked for each one of these synthetic assets and the APR. And I want to sort this from highest to lowest, and in this case you can see you have Twitter as the highest APR. Now I don't think I want to actually get involved with Twitter at the moment, especially with Elon Musk doing his thing over there. That stock has become very volatile, and so I'm looking for something that actually is not quite as volatile. And so in this case, Coca-Cola pays the second highest APY, and in reality it's not a tech stock. It's not typically subject to big swings. And actually, if I jump over here to Coca-Cola's chart, you can see that it is trending upwards. And if we get out our little tape measure here and measure from perhaps the low to the high, which is currently the high, this entire move over about a 1-year period is only about 30%. So that's actually not a lot of volatility. Twitter in one day had a much bigger move when Musk did his investment. A lot of your tech stocks will have those bigger moves. In a 1-year period of time, a 30% move on, say, Coca-Cola is not a huge move. Each one of these little moves up and down is not going to put you at risk of being liquidated. Therefore, I would be comfortable taking a shot at Coca-Cola. And so we're looking at an APR of 44% with the breakdown starting at 13% for the first 14 days. After 14 days, that's when I will start earning the 44%, as we discussed earlier with the 2-week wait period on the long farm side of your positions. So now all I need to do is click on invest, and the strategy will be delta neutral on MKO, which is the ticker symbol for the synthetic version of Coca-Cola. And the max I was thinking I would invest would have been 1,000 UST. But it turns out I will need 2,000 UST to make this investment. So I've got to jump back over to KuCoin, buy some more UST to complete this transaction. All right, so now I have the 2,000 UST. Let's click on Coca-Cola Invest. I will do 2,000. That meets the minimum. The fees and settings you'll want to take a look at, and in this case you can see the estimated gas fee is going to be 1.57, so you will need to leave a little extra UST in your wallet. You can't send the max amount in your wallet because you won't have enough to pay the fees that would be required to deploy this strategy. I'll have 157, and then I'll also have a fee of 374, and then at the end of the thing I'll have a fee of 10%. And then next, if we look at the target collateral ratio, I mentioned that when we're going through the docs, is set at 198 for the default, and that basically determines that if the price of MKO has to increase by 80% for me to get flagged for liquidation. And you can mess with the slider bar to whatever percentage you feel comfortable with. And you can see if I go higher, then the price has to increase by more. But that does affect your actual APR over time. And so I'm going to slide this back over here. And I'm going to set it at 199, and that gets me at that 44.34% APR that I was after. So now I just click invest, and I need to confirm, so I click post. All right, that transaction was successful, and you can see my portfolio current value is $1,996 and change. The original value was $2,000. The total return is a negative $3.72. That is the fees that we saw when I deployed this strategy. I can click on View Details and then click on the Delta Neutral MKO position. And that will give me a recap of the position, and my current real-time APR has actually gone up a little. It's at 44.50%. And with all that, I think that pretty much wraps it up. I will do an update video on how this strategy is performing in the future, so now would be a good time to shoot that subscribe button. If you like this video, do me a favor, spike a like. If you have questions or comments, drop them in the comment section down below. I will drop links to Aperture Finance, Qcoin, the Terra Station wallet, Anchor protocol, all those things I will drop in the description down below. And in closing, remember, never send your money into battle without first doing your recon. See you in the next video.